Ladies and gentlemen, good afternoon. We are ready to start this event, and I'm very honored and pleased to bring you the welcome greetings of the school. The event is co-organized by MISP and Banca d'Italia, and this is a very important event focusing on a very important topic. I'd like to say a couple of words about it. In particular, sustainable finance and investments is a very appropriate topic for, opening a discussion with within the MISP community, and in particular, targeting our students, which are today attending in presence this meeting. Why sustainable finance and investment is such an important topic? Because we are, as a business school, but also as academics and together with the institutions, trying to refocus what the role of economic institutions should be in the future. And of course, the challenge is to combine the search for economic value and the pursuit of sustainable development goals. This is really challenging. It's not obvious to achieve. And we are very happy that this may be a first opportunity to discuss it. Second relevant point to underline is that we are doing this today with the support of a highly reputable and high-standing institution, Banca d'Italia. That is not only the Italian central bank, which, by the way, means that they are regulators, they are economic agents for the implementation of economic monetary policies, but they are also a very qualified think tank. They have, the position and the perspective to understand firsthand what's going on in the financial system, and in this case, how sustainability can be incorporated in the behaviors and the structures of financial markets and financial institutions. Third point I would like to stress is that we are sharing the views of Banca d'Italia and ours with a qualified number of speakers, bringing the perspectives of academia, of financial institutions, such as Assicurazioni Generali, which is part of the panel, which later on will discuss the study by Banca d'Italia, and also big corporations like Hera Group. Assicurazioni Generali, Hera Group, they are stakeholders of ours. So we are very happy that not only we have Banca d'Italia together with us, but we are also hosting our stakeholders. Even more important, we are happy to share this topic with you, our students. For those that are not knowing very much about our full-time masters, our students, they represent a very broad community of international students coming from more than 20 different countries. And we are very happy that this topic is brought to their attention because of their young age, first. Second, because of, again, their international profile, and in particular, because in consideration of their expected roles in the future, economy and society, it is just, obvious to sort of make a call to them to sort of try and incorporate such new challenges into the old habits of running the economy. Finally, I'm very happy to say hello to all the people connected with us from remote, those people that we call the MISP community. So in leaving the floor to Mr. Martella, the director of the Trieste branch of Banca d'Italia, I wish you all, a very fruitful meeting. Thank you.
Good afternoon, ladies and gentlemen. First, let me thank Dean Professor Andrea Tracogna and Professor Giorgio Valentinus for accepting our request to host a meeting on the topic of sustainable finance, aimed at the students of the MIB School of Business. As part of its commitment to environmental risks, the Bank of Italy carries out and disseminates research on the possible macroeconomic and financial effects of climate change and on the opportunities offered by sustainable finance, also with the aim of raising awareness among financial intermediaries, investors, savers, and the general public. Today, we have two specialists in the field who work in the head office of the bank, Vittorio Siracusa and Ivan Faiella. Vittorio works in the public debt division of the Market Operations Directorate, the unit in charge of public debt placement on the primary market. Vittorio will present a paper entitled Green Bonds, the Sovereign Issuer's Perspective, written with other two authors. Ivan Faiella is a senior economist at Economics and Statistics Directorate. He is a coordinator of the G20 Task Force of the Bank of Italy for Sustainable Finance, member of the G20 Energy Sustainability Working Group, member of the Network for Greening the Financial System. Vittorio will participate in a panel discussion with market experts, sharing with us his vast experience and knowledge on the topic of sustainable finance. The paper presented by Vittorio is part of the new series of publications of the Bank of Italy called Markets, Infrastructures, Payment Systems. The new series of publications have been developed to favor the dissemination of knowledge on these topics and to foster debate between institutions, economic operators, and citizens, sharing the experience and knowledge gained in the field by the Bank of Italy. To give a maximum publicity to the papers published in this series, the Bank of Italy has decided to organize local meetings with universities, economic operators, and citizens. The Trieste branch of the Bank of Italy is working towards this through a cycle of presentation at the universities of Trieste and Pordenone. With regard to the topic of sustainable finance, it is important to underline that the risks associated with climate change also have implications for central banks and their main functions: the supervision of financial intermediaries, the protection of financial stability, monetary policy. According to our governor, Ignazio Visco, first of all, central banks can help to raise awareness and develop a better understanding of the risks related to the sustainability factors at the channels through which they are transmitted to the financial system. Secondly, central banks can promote the dissemination of more and better information to bridge the current gaps in the quality, consistency, and comparability of the available data on sustainability risks. The setting of information standards on climate and sustainability risk will facilitate the disclosure of companies' exposure to environmental risks and the measurement and management of climate-related risks by financial intermediaries. Finally, central banks can also support the transition to a low carbon and sustainable growth by leading private investors by example through the adoption of suitable policies for managing financial resources and the related risks. In this regard, the Bank of Italy has adopted a new investment strategy that integrates ESG factors into the management of its equity portfolio, as described in detail on our website. Now it's the time to pass the podium to our first speaker, Mr. Vittorio Siracusa. Thank you.
Thank you. Esteemed guests, members of the panel, the faculty, ladies and gentlemen, good afternoon. I'm very happy to be here to illustrate some topics in sustainable finance and also to present the paper entitled Green Bonds, the Sovereign Issuer's Perspective. Thank you, Professor Tracogna and Mr. Martella, for your introduction. This presentation aims at making you familiar with some sustainable finance topics and to create a basic understanding of the main features of green bonds and the relative market drivers. It aims also at raising some key discussion points that may be deepened afterwards in the panel. So a premise, first of all. We all know that global warming is a reality. This picture shows the monthly global mean temperatures especially in the last decade, as you can see. I hope you see also, yeah, compared with pre-industrial levels. So we see that global warming is a clear danger, and global warming turns into climate change. This is picture showing only some extreme events in the world. Climate change turns into two sources of cost for the economy. One of these is the physical cost that is due to the disruptions from extreme weather events. Yes. Okay, thanks. This is fine. Okay, thank you. So I was saying that we have two sources of cost for the economy. One is the physical cost of climate change that is due to the disruptions from extreme weather events. And you can think easily to assets that become destroyed after such events and to the harms to entities' balance sheets, especially in the financial sector. And the other source of cost is the so-called transition, indirect cost, that is due to the impact of the transition towards a new economy, a greener economy. In this respect, you can think to stranded assets or capital that becomes devaluated during this transition, or to the massive restructuring in supply chains, or even to the investments needed in the infrastructure sector. Green finance is mostly concerned with financing the green transition, so this second time of cost. We can see that we are called to address climate change effectively, but how can we deal with it? This picture portrays a peaceful protest in Bangkok done by cab drivers who decided to build small gardens on top of their taxis. But these kind of initiatives are clearly not enough. We are called to address extreme risks, and we can do that with thanks to financial markets. That's why we will cover some topics. The first one is the sustainable fixed income market, and then we will focus on green bonds, illustrating the features and standards and looking into the general market. We will also have a spotlight on sovereign green bonds, and especially on the relevant experiences of this market compartment, and then focusing on the financial performance of these instruments. Finally, we will summarize what we have done. So financial markets are very important. Why? First of all, financial markets provide information. This is a key input for economic and policy decisions, and it is a daily input you can observe on markets. Secondly, financial markets allow a good allocation of funds to sustainable investments and can promote the technological transition we need in our economy. Finally, financial markets are clearly very useful to manage and share climate risk. You can think, for example, to the role of insurers in the economy. And financial markets offer multiple tools. Here we are in the debt space, with green bonds taking the lion's share, in the sense that we have many kind of bonds. You see, we have green bonds, social bonds, sustainability-linked bonds, and transition bonds that altogether have an outstanding amount of more than $2 trillion US dollars today. As you can see, the vast majority of this bond is constituted by green aligned bonds. But what are the differences between these instruments? As you can see, the format is divided in use of proceeds versus entity KPI linked. What does this mean? This means that with a use of proceed bond, an issuer is called to be constrained to use the money it raises on the capital markets to specific projects. So there is a real constraint. And these projects are clearly environmental and in green project. When we talk about green bonds, they are social purpose bond projects. When we talk about social bonds, such as stimulating the labor market, they are a mix of the two when we talk about sustainability bonds. With transition bonds, we address the shift that those more brown companies, we can call them this way, are called to do in order to have a green business model. Sustainability linked instead are another kind of tool that is not a use of proceeds tool. So basically, when an issuer issues a sustainability linked bond, is not called to use them specifically for a project, but within the maturity of the bond, it is called to reach and achieve some targets, sustainability targets that are measured through KPI, so key performance indicators. These kind of tools are belong to the world of ESG, so environmental, social, and governance bond. And today we are going to focus on green bonds specifically. You may ask, what are these sustainable goals? What does sustainability mean? A definition can be provided by the United Nations. Since some years ago, a set of 17 goals have been outlined, and you can see that the ones outlined in blue are those objectives that have been covered for the majority by the issue of sustainability bonds. You can see we have good health and well-being, as well as affordable and clean energy or climate actions. This set of objectives is quite inclusive. So there are many activities that can affect positively the world and the society in general. We are going to focus on green bonds. And in this respect, this presentation reflects a dedicated study that I co-authored at the Bank of Italy with my colleagues Raffaele Doronzo and Stefano Antonelli. And that, as was said before by Mr. Martella, has been published on a new paper series called Market Infrastructure and Payment System. So you can download it for free. We see that green bonds have the use of proceeds constraint, as I said before, but the general purpose of this bond is clearly to finance eco-sustainable projects. The demand that usually arises is what is the difference between these bonds and the conventional bonds that we usually see on debt capital markets? And the answer is that they are identical in their structure. So a green bond has a coupon, as a price that you can buy it, and a price at which you will be able to sell it. It has a maturity, but apart from this, since there is the constraints on the use of proceeds, investors will be interested in how the issuer will use this money to create some environmental benefits. So they will assess the environmental allocation of funds. When we see the difference, the comparison at least, between these two instruments from the perspective of the risk, we understand that they are identical again, because the risk of a green project stays with the issuer, it is not translated into the green bond risk. So a conventional bond and a green bond issued by the same corporate, for example, share the same risk. And green bonds are increasingly demanded by those investors who adopt ESG criteria in their investments. Green bond, this is a notation, does not mean pure green issuer, in the sense that an issuer which is active in both the brown and the green fields is perfectly capable to issue green bonds as long as these bonds are used to finance the green parts, the green portion of its business. And this is the case, for example, of Iberdrola, a Spanish energy producer that issued almost $4 billion of US dollars green bonds that is used to finance around the 15% of its business. You may ask, if this is the first time you look into green bonds, what are the reasons to buy or sell these bonds? If we give a look at a survey conducted across some institutional investors, we can see that the most important reasons to invest and buy these tools have been reputational benefits, ethical obligations and fiduciary duties, and investment returns benefits or portfolio risk reduction. While on the other side, the most important reasons for especially sovereign issuers that have been interviewed in order to issue these instruments are curbing climate change, stimulating the growth of local green markets, giving a market signal, and obtaining some reputational benefits. So this means that these entities enter into the green bond market by either buying or selling these instruments because they do want to have an impact on climate change, to have a good impact, but they also so far have had some benefits, especially in terms of reputation and visibility. So why we need some standards, why the market needed some standards at the beginning. Investors, as you have understood, want to easily identify bonds with these climate-related benefits. So over the years, the importance of certifications have grown. And this is true for all kinds of green bonds, so that a phenomenon called standardization has arisen. Standardization is the creation of non-binding rules that the fixed income industry can decide to follow on a voluntary basis when issuing green bonds. And two main market standards have arisen. The first is the Ecma standard. Ecma is the International Capital Market Association that represents the financial markets worldwide, so all those entities that take part to financial markets. While climate bond standards have been issued by the Climate Bonds Initiatives, that it is an international NGO active in mobilizing capital for environmental purposes. What do these standards ask? We now look in depth the Ecma Principles. These principles basically ask issuers who want to put the green Ecma label on their bonds to follow a process when issuing this bond. And this process starts with making it clear what will be the use of proceeds. So why they are issuing these bonds and where the money will arrive in practical terms. So that to assure investors that the projects under these bonds have really some environmental benefits. Then the issuer is called to disclose what was the process to evaluate and select the project that will receive this capital. In the sense that there could be a rationale for excluding a project and for including another one. There is also, and this is very important, a step that is the management of proceeds. So who gives investors the certainty about the tracking of this money into from the financial system into the assets that will receive this investment? It is the issuer that has to make it clear at the beginning how he will track the destination of this money. And this is important because it is done to avoid the so-called greenwashing. That is a misleading claim. It is basically, it means cheating. So issuing a green bond, but using the proceeds for purposes that are not green, in part or totally. Finally, there is the reporting. So all these issuers are called to periodically inform and disclose to investors what they are doing. We have mainly two kinds of reports: allocation reports and impact or performance reports. Allocation reports are useful to understand exactly how the money has been spent. Impact or performance reports are important to understand what were the consequences, the positive impacts, hopefully, of spending this money into the selected project. And how does an issuer do that? It does through releasing a so-called green bond framework. That is a document usually issued some weeks or months before tapping the market that illustrates all these phases and anticipates the reporting, and that is usually subject to an external review. So Ecma Principles, in fact, ask also for external reviewers, so external societies that are experts in the field of sustainability, to say what they believe about these green bond frameworks, and very often to assign a so-called ESG score. These reviewers make the job of preventing, in substance, the so-called greenwashing. And very often these reviewers, that we can also call ESG rating providers, are called also to certificate that their periodical reporting is aligned to what is being done in the corporate or generally in the entity that is issuing these bonds. We can see that standardization is an important phenomenon, and since it is key to avoid misleading use of these funds, the European Union did not decide to sit up, but it decided to take some action. How? By establishing a common language known as taxonomy. This is a regulation in force since last year that states that to be qualified as sustainable, economic activities have to comply with 6 macro-environmental objectives and 4 requirements. As you can see, these are the objectives. The first 2 are climate change mitigation and climate change adaptation. And the requirements are for, the first one is for an economic activity to be considered green, truly green, to provide a substantial contribution to at least one of the environmental objectives set here. The second one is the requirement of causing no significant harm to any of the other environmental objectives. And here, for example, is where we are seeing some discussions worldwide about the nuclear energy. Nuclear energy, from the standpoint of the carbon dioxide production, can be considered clean because it does not issue greenhouse gases. But on the other side, as long as the nuclear waste cannot be stored properly, this could be a danger. And of course, that becomes an harm towards other environmental objectives, for example, healthy ecosystem. There are also some other requirements that are complying with robust and science-based technical screening criteria. These have been finalized only for the first 2 macro-environmental objectives, and also to comply with minimum social and governance safeguards that regard business principles and respect of human rights, basically. But the European Union is not the only entity that is moving in this direction. We are seeing that many other continental and national areas are active on this field. And so this ends into what we call taxomania. So the creation of the world of multiple taxonomies that is truly a taxonomy competition. This creates fragmentation because an asset that can be considered fully green in a part of the world may not be considered as such in another area. So now we can see what are the market dynamics. And we see that the bonds growth, the green bonds growth has been impressive. This market compartment started in 2007, thanks to the issue of the first European Investment Bank green bond. It started developing from the year after, thanks to the World Bank, who started issuing other green bonds. And today, it amounts to almost $1.5 trillion of US dollars. 2021 saw a record, is a record actually of issues, and the expected growth over 2020 is at around 70%. Green bonds are covering almost 61% of the sustainable bond market, and we can expect annual issuances to tap the 1 trillion starting from 2023. But this may not be enough. The climate bonds initiatives stated that we may need an outstanding amount of at least 5 trillion US dollars worldwide in order to address properly the green transition. You can see also that there are many kind of issuers. We have governments, agencies, financials, and corporates, with governments representing 29%, so almost 1/3. Governments include sovereign and supranational issuers. We see as well that governments, financial and utilities are the top issuers. And this is not surprising because the public and the financial sector are responsible for financing large-scale transition projects, but it is utilities that represent the corporates that are most advanced in implementing these projects. Europe, when we look at geography, is leading the supply. And it is doing so also thanks to the Recovery Fund. This is the improper name. The proper name is Next Generation EU, that represents the program launched starting from last year by the European Commission, under which it plans to issue 250 billion euros of green bonds, so that it could become, in few years, the largest issuer of green bonds worldwide. We saw an inaugural issuance in 2021, so it was last month. That was a record issuance for the demand and also for the amount that was tapped on the market. If we look at currencies, of course, it is not surprisingly that euro represents the most used currency. We see it on the outstanding amounts, but also looking at the 2021 issues. Here it is even more evident. If we look at the market from the rating perspective, we see that the big bunch of these bonds are in the investment grade space, while only a minority stays in the sub-investment grade space. And this is not surprising again, because it is due especially for the notable shares of governments that issue such instruments. The average maturity is quite high. It is on average 10 years. That is quite a lot. So they are not extra long bonds, but almost. And we have some fields, for example, the industry of utilities that usually issues bonds on very long maturities. This is a 17-year-long average maturity for the industry. Now we can have a spotlight on sovereign green bonds. That represents the core of the paper, by the way. So why are we focusing on sovereign green bonds? The first reason is that the growth of sovereign green bonds can significantly stimulate the growth of local green bond markets. How? First of all, sovereign issuers can serve as a role model for other kinds of issuers. In particular, let's imagine what a corporation can do if it has in its own economy an example, a paradigm of issuer that has already went into the market. It has already gone into the market. So the issuer, the sovereign issuer, can really set the best practice in the field. Then it can also provide for the market itself a benchmark. So there will be an instrument that is priced on the market. And this, of course, is an anchor for pricing other kind of instruments. For example, corporate green bonds or green bonds issued by sovereigns and by financials, sorry. And I don't know if there's a question or it's only, okay, anyway, feel free to interrupt me if something is not clear. And also the opportunity to bring new investors into local economies, because some investors, let's think to foreign investors, may be interested in buying a corporate green bond only after they have known a bit a market. And they will do this most probably by issuing the most well-known bonds that are usually sovereign. So the sovereign issuances can attract new investors. They can also be useful to central governments to enhance other strategic initiatives. For example, taxes on carbon could be easily complemented by the issuance programs of such bonds, and so the investments that are consequently pursued. Also, another function of sovereign green bonds is redirecting consumer savings towards sustainable activities. Again, let's think to those consumers, those households who do not want to expose their finances towards issuers that they don't know very well, because they operate in the technological sector and there is no great knowledge of the inputs of this sector. Probably they will be willing more easily to buy a sovereign bond, a sovereign green bond in this case. And this is what is happening, for example, in the United Kingdom right in these days. Also, green bonds have the power to amplify the transparency. When we talk about public finances, of course, transparency is key and is usually very well addressed. But with the publication of reports, this is even deeper. We see that when sovereigns are called to issue their bonds, they have to follow a stepwise process. This means that after they get the approval from central government, they usually establish an interministerial working group within the priorities are identified. And these priorities lead to the selection of eligible expenditures and in turn to the identification of the final projects that will be financed with these bonds. Finally, sovereigns are called also to anticipate the reporting that they will do towards market. This recalls the Ecma principle structure that you saw before. And in fact, Ecma principles are the most widely adopted standards worldwide. These three phases are usually done by issuing what I called before green bond framework. So this is the first document that arrives into the market that for an issuer is key to convince final investors. Usually in these documents, also some characteristics of the financial instruments are outlined. For example, the range of maturities in which these will be issued. There are many benefits, not only for the multiple stakeholders, but also for the issuers themselves. First of all, we have a macroeconomic benefit because, in fact, when addressing climate risk and climate change policies, there is an implicit intergenerational trade-off. What does this mean? Most probably, the generations that will benefit most from the current policies, climate policies, will be future generations or those generations that are now very young. But the cost of these policies that cause us to change our lifestyle will be borne mostly by the current generation. And so this is a trade-off. Green bonds help solve this trade-off because they are very useful to raise capital right now, but repaying it over time. Actually, repaying it very usually in a unique solution at redemption, that can be, for example, in 30 years, and by paying interest over time. So they solve, in a certain way, these trade-off. The other kind of benefits are financial and reputational. From the financial point of view, a sovereign issuer is interested in making its bonds known in many markets. And so, thanks to the presence of ESG investors that are hunting for these green assets, it can expose its debt to a broader investor base. The same actors of the financial markets, so these ESG-oriented stakeholders, are very often those players that we call real money investors. So pension funds, insurers, asset managers, they're interested in buying these bonds and very often to keep these assets into their portfolios rather than selling frequently on the financial market. So this creates an incentive to lower the volatility of these instruments. And this is another benefit, of course, for the issuer. Some issuers have also experienced a better pricing, the so-called greenium that we will see in depth later. And also the average outstanding debt maturity can increase because it could be dragged up by the usually long-term maturity of these bonds. In fact, green projects usually require investment for long years. We have a high maturity of these instruments, as we saw before. So this effect is very common among issuers, especially among sovereign issuers. And there are also reputational benefits in terms of showing the long-run commitment towards citizens and more general towards markets, increase the visibility, and in some cases, this is known in literature as halo effect. There is the opportunity to generate a virtuous cycle. So a better reputation turns into better financing conditions that are applied to all the curve of an issuer, so to all the bonds. And this is, as I said, the so-called halo effect. We see that there are, however, some issues that remain open. The first one is if these green projects are usually new or not, because as long as a project is green, a green bond can be issued. But if the expenses are not additional to what we have already done, we are not addressing properly the climate transition we are called to realize. So this is actually a question mark. And also for a sovereign issuer, it is fundamental to understand the effect of launching a green bond on the existing debt. This is particularly true for small issuers, so those countries that do not have high financing needs, or those countries that are small, and so they really cannot have very high financing needs. In particular, the first point is the effect on liquidity. Let's imagine that there are preset financing needs. For example, a country needs to issue per year 100 billions. And let's imagine that this country has on the market multiple lines of bond. For example, a 2-year bond, a 5-year bond, a 10-year bond, and a 30-year bond. This means that each year, these financing needs will be spread over these lines. What happens when a new line is added? For example, the green bond line on a 20-year maturity. The amount will be spread on more bonds, and so the outstanding amount of each bond will grow very slowly, or more slowly at least. This could be perceived by the market as a lower disposal of these bonds on the market. So it will be slightly more difficult to buy and sell them easily, or at least at the prices close to their value. And this becomes a signal of relative illiquidity of these bonds that calls for a cost, and liquidity cost for the issuer. So this could be a damage caused by launching a green bond. Otherwise, if the same issuer decides to substitute a bond, and a conventional bond already existed with a green bond, he will have to be sure that this green bond will be issued for a large amount. In this case, for example, with the 4 bonds and 100 billion bonds, imagine a flat distribution. We will have 25 billions per line. And this means that if that country does not have 25 billion of green projects, it will not be able to issue these bonds with a sufficiently high outstanding amount. And so this calls for some innovation. One of these has been the so-called German twin model that we will see only if we have enough time. But just to give you a flavor, this is a model where the issuer decides to issue a new green bond with exactly identical characteristics to the ones of an existing conventional bonds that is considered sufficiently liquid by the market. This way, investors see that the two bonds are almost identical in coupon, maturity, and other structures. The issuer also assures markets that it will do some switch transactions between the green bond and the conventional bond should the performance on the secondary market of the green bond be lower than the one of the conventional bond. So in the moment in which on the market the green bond is not so good, is not going so good. So it does not keep the same value of the conventional bond. It will be easily exchangeable for free. This means that the investor starts considering the green bond liquid just as the conventional bond. And so this is a potential solution. We also have some administrative costs. This is another question mark in the process of issuing these sovereign bonds, because the cooperation between different ministries, between and among different stakeholders, calls for coordination and executive leadership. And this effort, of course, has a cost. Now we can look at what have been the most important experiences in the field. Again, when talking about sovereign green bonds rather than simply green bonds, Europe steals the show. And this is pretty much visible in this slide. We have the big picture here. So this picture represents the evolution of the market. As you can see, the market is populated by a lot of European countries. You can see the European Union, but this is only for illustrative purposes because, of course, it is not a pure sovereign. It started developing in 2016, thanks to the efforts made by Poland and then France. And it is knowing great growth in 2021, thanks to the new issuances of UK, Italy, and Spain that have entered into the market. But last year, it was the year of Germany that started issuing more bonds. And here, when we look at Germany, we see a particular pattern. In fact, Germany is aiming at creating a green curve of bonds. So they explicitly stated it, they want to spread their financing needs over more lines of bonds. You can see the 5-year, the 10-year, and almost the 30-year. When we talk about extra long maturities, we see that the most active countries have been Germany and United Kingdom, with also Chile, Poland, Indonesia, and Hong Kong. We see that the concentrations in terms of maturity tenor are around 10 years, starting from 7 years to 15 years, I would say, and also between 20 years and 25 years, while the range usually is from 5 years to slightly more than 30 years. This makes us understandable the fact that this market has a very long maturity, average maturity, that is 19 years. And that is higher than non-green sovereign bonds and then green non-sovereign bonds. Here is pretty much what I just said. And if we look at what were the main 4 issuers, we see that all these countries have decided to align their green bond frameworks to Ecma or CBI principles. So these are really the standards, not only for the name they have, but for actually the kind of use that the market is making of them. There are different expenditure patterns. For example, look at how the transports account in these 3 countries, Germany, Belgium, and Netherlands, and how they account for France. But more generally, this project has been selected through interministerial coordination, and all these issuance have foreseen the release of periodic reports. These reports that are usually validated both internally and externally by the ESG rating providers are very often allocation and impact reports. Again, in allocation reports, you will read how the single euro that has been borrowed on the financial markets has arrived into the final asset. While with the impact report, you as a reader will know, generally speaking, what has been the benefit, the concrete benefit of that expense. For example, how this is useful to quantify the greenhouse gases emission that have been saved, or the lands that have been preserved thanks to these bonds. We can also look at how the inaugural issuances have gone on the markets, and we see that in every case we will have had a broad investor base with concentrations among a strong concentration among real money investors, so asset managers, pension funds, and insurers. So in the previous slides, that was a supposed benefit. Now we are seeing that it is real, it is concrete. And the demand was mostly domestic and European. We also can give a rapid look at the green BTP that was launched this year. We see that there is quite the same pattern when looking at the investor base, because asset managers subscribed exactly half of the money that had been sold on the market. That amounted to 8.5 billion euros in the first issuance in March 2021 and to 5 billion last October in a second syndicated deal. This bond, this BTP, will have the release of an allocation and impact report together published annually. So the actual benefits, and this is not being taken from the literature, but this is actual, the source is a survey done across the sovereign issuers. These benefits are multiple, and we can see that, first of all, these bonds have received a higher demand compared to conventional bonds. And this is key to be kept in mind. A big part of these issuances, 44% on average, was allocated to ESG investors. And in most cases, new investors have bought these bonds. And this resulted in multiple sub-benefits. One of these is the so-called greening that we will see in a few minutes. Most of the funds have been allocated to new projects, and this is good news. Only some jurisdictions where the parliament had to vote, firstly, the expenses, were not able to finance really new projects. But as long as this project in the future will be voted and subsequently after financed, this could not be a hamper signal for the development of the sovereign green bond market. And for the development, of course, of new investments with a good impact. On average, issuance and ongoing costs have been higher than those of conventional bonds. But in the end, the thought of these sovereign issuers is that they have been outweighed by all the other benefits. We shed some lights on impact reports because they are very important. Because from an investor perspective, with the growing markets, in order to understand what is the green performance of an issuer compared to another one, it is fundamental to have a piece of paper you can read, you can trust, of course, where you can see what was considered more effective in terms of project. And here we have, in fact, some of the metrics that are used in these impact reports, with greenhouse gases saved having the majority share. These reports are very important, but we are seeing, and this is what has been denounced by many international organizations, that the climate disclosure is fragmented. So there is not a unique standard, a unique template of impact reports. And this, of course, is exacerbated by the growing of taxonomia, so the multiple taxonomies over the world. Also, the granularity of information is heterogeneous in the sense that there are some reports, practically speaking, that are 200 pages long, while others are 50 pages long. This means that information is not the same for each issuer and for each project. Also, these metrics, the mostly used metrics, are not always science-based or discussed in absolute values. Why? It's because when the market started developing, investors were not used to read about climate change, climate risks. So in order to make to them understandable what was being done by issuers, there was the need of using some metrics that were more familiar to the final investor, so maybe also not science-based, and also relative, so to make to investors understandable the progress that the issuer had done along the years. But if we want to compare the issuer performance with his peers, we need absolute metrics. And now that we understand that climate change is a priority, we are ready to understand also more science-based metrics. This calls for more transparency in the use of these data that currently are kept by the issuers and the ESG providers. And it is done for the benefits of the financial market itself, because, as I said at the beginning, it is decision-making that is affected by the transparency and the clarity of these data. Another core part of the paper is about the financial performance of these tools. And in fact, we see that one of the major concerns in the primary and secondary markets is the presence of an yield differential between green bonds and their non-green peers. We mean, since green bonds and conventional bonds issued by the same issuer with similar characteristics, so similar maturity, similar coupon, are essentially identical, why can we see on the markets that there is some differential in the price and so in the yield? This differential is called greenium, in the sense that when we see a greenium, this means that the yield of the green bond is lower than the one of the conventional bond. This means that the price is higher. So when we see greenium, we see that the evaluation of the green bond is higher than the one of the conventional bond. And so we will see that when we have a negative greenium, this is exactly the opposite. It is the conventional bond that retains more value compared to the green bond. There are some reasoning that have been done in order to understand the difference in price. In particular, we see that the existence, as we saw before, of a specific green investor base, that is the ESG investor base, is a reason for an excess demand compared to supply. So as long as supply is not fully stimulated, we will see these investors hunting green bonds, and this, of course, pushes the prices up. This is true even if we consider the potential benefits on volatility from the presence of buy and hold investors. But by contrast, since green bonds are issued with constraints on the use of proceeds, the outstanding amount of these bonds is usually lower than the one of conventional bonds. And so this is a case for a lower liquidity, and lower liquidity may result into a lower price. And so in what is a negative green. So these are pretty much two kind of forces that can compensate, or one can prevail over the other. That's why we asked three questions. The first one is relative to the primary market. So we asked, is there a price advantage for sovereign issuers in issuing green bonds? So is there an advantage for the issuer in choosing to issue a green bond rather than a conventional bonds or otherwise? We also asked, and this relates to the secondary market, if these green bonds outperform the non-green peers, so the conventional bonds, and if green bonds can be considered more resilient in periods of financial stress. For this purpose, we analyzed what happened in the sell-off of March, April 2020. How we did it, we saw that literature did not give a precise answer to these questions. There is a mixed evidence of greenium, so we took especially the methodology that have been used. And of course, when we're talking about methodology, you can see more in detail what there is on the paper, but of course, feel free to reach me out by email if something is not clear or if you are curious to know something more about that. The methodology pretty much aimed at first collecting all the issuances of sovereign green bonds up to 2020, and to record exactly the yield at issue for each of these bonds and each tranche, because each bond is issued for the first time, but the following tranches are reopenings of the same bond. That's how a bond grows in its outstanding amount. This gave us a measure, an observation, a real observation of what was the yield at issue for these bonds. We needed to build synthetically what would have been the yield at issue for a conventional bond with the same identical characteristics, so maturity and coupon especially, if it had been issued on the same day of the issue date of the green bond. And so we did it by using the data from the secondary market, looking at the yield to maturity on the green curves. At the end, we had a data set consisting of 38 observations of differential between the green bond yield and what had been done if a conventional bond would have been issued. So 38 observations for 10 countries. What did these observations contain? On only 9 cases, the ones outlined in green, we saw a positive greenium, so a lower yield for green bonds and a convenience for the issuer. In these cases, the issuer saved something, we can say this way, saved something in choosing to issue a green bond rather than a conventional bonds. But for the remaining 29 observations, we see that the green bond yield was equal or higher than the fitted yield. So this means that in all the other cases, the ones that are not outlined actually, there was an extra cost. For example, here there was an extra cost of 2.9 basis points. On average, we see that greenium is negative, so there is a small but statistically significant extra cost for issuers that choose to issue a green bond rather than a non-green bond. This cost is, as I said, statistically significant, but just in actual terms, if you think to a bond issued for an amount of 10 billion with maturity in 10 years, this means 38 million over the 10 years. That is slightly less than 4 million per year. So this is not a high extra cost, especially for a government or a sovereign issue. We saw also, however, that the negative greenium, so this extra cost that is represented here, gradually dampened over time. So we tried to understand why, and we find a possible answer in liquidity. Because, as I said, when a bond is opened in multiple tranches, each tranche increases the outstanding amount. With a higher outstanding amount, these bonds become more liquid, or if we want, always less illiquid. In fact, we found a positive relationship between the green bond size and the greening. So the potential explanation that we gave is that at the beginning, the illiquidity effect may have prevailed over the excess demand effect. But when illiquidity when more liquidity entered into the market, the scarcity effect, so the high demand effect, was prevailing, or started to prevail, of course. So the answer to the first research question is that in the primary market, sovereign green bonds are on average slightly more expensive, but slightly, and that the lower performance of a conventional bonds is likely to reflect poor liquidity conditions. As these improve, these extra costs tends to decline. We then passed on to the secondary market. So the data set was slightly different because we focused on France, Belgium, the Netherlands, and Ireland, for which we had data in the continuous time, so daily data, not single data in the discrete time for each issue. And after looking at the yield to maturity, we focused on the Z spread, just because this is a measure that helps us get reading of a potential bias arising from a different duration, due essentially to different coupons. We again built a synthetic conventional bond, and in the end, what we saw by comparing the two Z spread, one for the green bond and the other one for the conventional bond line, we saw a presence of a tiny average greenium of half of a basis point. This was done also after controlling for liquidity by running a panel regression. And what does this mean? This means essentially that also on the secondary market, the performance of green bonds and conventional bonds is aligned, because with the half a basis point, we're talking of 50 euros, so 50 euros on an investment of 1 million euros. So this means that there is a substantial alignment. And so we concluded that sovereign green bonds tend to trade fairly in line with non-green bonds. And also by looking at what happened during the crisis of last year, so the COVID-19 crisis, we called it like that, during the sell-off, so March and April, substantially nothing changed compared to the other periods. This finding, according to us, is important because it shows that green bonds are different in the use of proceeds compared to conventional bonds. So essentially, these are an instrument that can be used in a good way. And on the other side, it does not show a significant extra cost. So this is quite meaningful for us. Of course, this study can be improved by extending the scope of the bonds involved, by controlling from other price formation factors, and also by including the projections about the potential regulatory changes that may create further demand or further supply for these bonds. We also looked, but this is not included in the study, of course, because it is more recent, how the BTP and the Bund, so the Italian and the German sovereign bonds performed, and we saw that there was a certain greenium, which is of a more pronounced entity. 5 basis points for the BTP and 4 basis points for the German Bund. In the case of the German Bund, this could be a consequence of the twin model that they used in issuing these bonds, because the twin model accounts for liquidity. So if the relative illiquidity of green bonds is removed, we have only the effect of excess demand. And we may say that probably the differential in the German case can be due to this aspect. Just to wrap up, we have seen that climate change exposes the economy to physical and transition risks, and that financial markets play a critical role to achieve the transition. And they are useful, they do so by offering multiple kinds of debt securities. Green bonds are the most popular instrument in these markets, and they are subject to standardization in the issue practice. And an example of this is given by the European taxonomy. The growing issuances from sovereigns are important because they set the trend for more green debt sales in all the market segments. And these bonds offer some benefits that outweigh the cost. The market is characterized by the activity of many buy and hold investors, but overall, we cannot see the existence of a remarkable and systematic price difference between the sovereign green and conventional bonds. The lack of a clear evidence of this potential cost advantage, however, is not preventing more sovereigns to enter into the market, because the reason for issuing this bond is not given simply by an economic convenience. Instead, sovereign green bonds are very useful to show a country's long-term commitment towards climate policies, and also, in order to be used in a complementary way with other climate policies. We can also make something more by looking at the challenges ahead in the current debate. And I would like to start with what Margaret Callow, the WWF Global Finance Practice leader, said. She said, when addressing especially the transition risk of climate change, that the fight against climate change and nature loss requires substantial investment to change the way we use and produce energy, how we get from one place to another, and how we make and transport things, and also how we grow the food we eat every day. So, according to her, debt capital markets and the industry professional can help us save the planet and ourselves. We ask, they will, at what extent, and also within which time? Also, if we shift from the transition risk to the physical risk, we can also see what Tariq Fancy, the former head of sustainable investing at BlackRock, said when interviewed by the Financial Times, because he said that as long as financial institutions keep on pouring trillions into fossil fuel activities, so not only issuing green bonds, financing the green transition, but continuing to invest in the fossil fuel assets, an investment portfolio, he says actually that protecting an investment portfolio from the disastrous effect of climate change is not the same as preventing those disastrous effects from occurring in the first place. So we ask, can green finance actually shield us also against these physical risks? And finally, Andrew Steele, the global head of sustainable finance at Fitch, said that when it comes to debt instruments, they are focused on their purpose. They look at how the use of proceeds are managed, how projects are selected, whether they are additional, and so on. But, he says, the devil is in the detail. And that's why there should be a much higher weighting on impact and outcomes compared with policies and procedures. So we ask, to what extent can investors trust ESG ratings and reporting? And also, what kind of standards do we need to create a purpose-driven economy with impact at its core? These are pretty much the questions. Thank you very much for your attention, and I'm happy to answer to any eventual question.
Please stay. Thank you to the speaker, and I would like to open a very short but very important Q&A session right now, because later on there will be a sort of a round table, and which will be led by my colleague Giorgio Valentinus. But I think that you know, the right time now to raise any question from the audience. I'm also referring to the people from remote. In the case there are questions, and I hope so, from this hall, please come over here so that you can use the microphone. Otherwise, you know, people from remote will not listen anything. Okay, so do you have any question to raise? Again, even from remote, if there is. No questions? Yes, there is one. Can you please come over here? Thank you. Do you mind coming over here? Okay, I will repeat then the question. We are sorry, but otherwise people from remote will not. Okay, yes, please.
Actually, it's not a question, it's more clarification. Could you please open 26 slide?
Sorry?
26 slide.
26, okay. And here we are.
Perfect, thank you. And could you clarify what do you mean on the left figure about different bonds with different duration, and how do you explain why it's super significant power by government supra?
You mean this one?
Yes.
That why? Okay, that's these shares are done by referring to the absolute amount that have been issued. So actually, when we spread the bonds by rating, and also by industry, we see that big parts of the market is created by government supranationals. So inside this category, you have all the national issuances and also some other ones that have been done by, in fact, supranational entities that are not properly governments, but we include them usually in the same category. Because these are not corporates, these are not financial. So this is a kind of segment subject to different forces, different incentives, especially. And it is where the paper is mostly concerned. We see that, of course, they enjoyed, in many cases, the highest rating possible, so the AAA. I don't know if I answered your question.
Not so clear, actually.
Yes, please ask me.
Yeah. So actually, the question was why the government has so power here, and what is the distribution from 3A to 1D, and why we don't see the government, for example, in the middle. One, it's more powerful only at the beginning. And could you please explain that?
Of course. Now it's clear. Thank you. I think the answer, since we are here, can be given by maybe this slide. Yes, you see that the big majority of bonds have been issued by Europe, North America, and only after Asia Pacific, Africa, we have also here some supranationals. So the bonds issued by North American, European countries usually have higher ratings compared to the other areas of the world. And that's why these bonds that represent the vast majority, when we see them by rating, they finish to constitute the majority of the AAA. While the other, for example, also if you have to price a bond, a corporate bond in the market, I think you will consider riskier to buy a bond issued by a corporate than by a sovereign, usually. Because if the sovereign has some issues with public finances, it's most probably also the corporation will suffer potential losses and other problems. And that's why usually, if a government has a AAA, the actors in the same market, so the corporation may not have the same AAA. So that's why you see a concentration of government and supranational here at the AAA, while a lot of other players, for example, industrials, are spread over the other rating notches. I don't know if it's clear right now.
Yeah, no, it's clear.
Great.
Thank you.
Thanks to you.
Any other question from the audience? Because there are a few questions in the chat.
Ecco. Oh, possiamo fare anche share dello screen. Che è una cosa che mi hanno chiesto.
Okay. So the first question is, which are the biggest risks that are embodied in the greenwashing regulatory perspective? Regards from Guatemala. Thank you for your regards. So the biggest risks usually in greenwashing are simply to create disorder in the market and to deceive the money from the most important priorities. If we discover, for example, that an issuer has used his green money, so his green bonds proceeds to finance simply fossil fuels, but think to something completely different from green purposes, for example, weapons, what happens? It happens that the standard that was used to confirm the alignment of the bond to the Ecma principle becomes useless. And so if in financial markets also the trustworthy system, also the reliability of the market itself is an asset, because if you don't believe in the reliability of that market, you will not put your money in that market. And so the market will probably collapse and not exist. There are many, many risks from this standpoint. So of course, greenwashing is a risk because it is basically a fraud, cheating. And in each kind of game, when cheating is in place, the game finishes, ends. So this is basically the most general answer I can give to this question. Thank you for posing it. Another question is, since impact reporting is not mandatory, how does it impact on green bonds? And here the answer, I would say, is moral suasion. So it is true that reporting is not mandatory. It is true that these standards, even the European Union ones, are not mandatory, but they are the minimum requirement you have to fulfill if you want that label on your green bond. I come back to the one of the first slides. If you see here, these statistics, these are the green aligned. So this means that these are the bonds that produce reports. In this case, the CBI, the source that it is very well known and trusted globally, is not even considering those bonds, those green bonds that do not have alignment with principles. So coming back to the question, I would say that if a report is not produced, the alignment with the principle will not take place. And so this bond we will not perceive as a real green bond. I hope to have answered the question. Let's see, I don't know where it was. Maybe it's, yes, I think there is. We also have a third question. Can green bonds be used in conjunction along with other green finance instruments? Absolutely, yes. In fact, Mark Carney, I will use this quote. Mark Carney, the former governor of the Bank of England, that is now the chair of the Glasgow Financial Alliance, that is continually speaking in these days at the COP26, said that sustainability-linked bonds are very helpful in realizing the so-called 50 shades of green that we are called to achieve in the market. For example, the power of these instruments, and absolutely in the aftermath, in the panel, Mr. Moroni will tell us something more, since the ERA Group has recently issued its first sustainability-linked bond. These bonds can be very useful for small issuers if a small issuer cannot spend his money entirely on green projects because the minimum amount to be issued on green bonds is quite high, he will probably issue sustainability-linked bonds so that he will not have a constraint. He will not be forced to use the proceeds on a single project, but the most important thing will be that within the maturity of the bond, he will achieve some environmental targets that will be measured by KPI. So the answer is absolutely yes. Thank you for your question. I see no other question.
Okay,
there is another
one question.
Yes, maybe. Can you give us some example of the project finance with the proceeds of the green bonds? Yes, these are quite different, and this is what we see when we say that there is also fragmentation in reports. But for example, with a green bond, you can pursue the construction of energy, offshore wind energy places, so that platforms, most of all, as well as trying to increase their reforestation. These are, for example, two examples of what green bonds are useful for. Of course, these two, I take these two examples because generally, the most important objective in the current environment is to arrive at net zero emissions with different maturities. Let's say within 2050. How do you achieve net zero? You achieve it by reducing current emissions. So, for example, by using renewable energy instead of fossil fuel energy when you build an offshore platform to exploit wind, but also you can reach it by creating the so-called negative emissions, negative greenhouse gas emissions. And for example, creating more forestation, so what is called reforestation, is very helpful because, and that's why we talk about green bonds. It is trees and plants that can help us to store the greenhouse gases in the atmosphere. And so they actually cancel them. They store it in the soil, actually. But these are two kinds of projects that can be financed with green bonds.
Okay, thank you so much for your very interesting, rich of details speech. And now it's time to for Giorgio Valentinus to take the floor and to invite our panel of speakers, which may comment on what was raised and perhaps also open new perspectives on the topic. So please, Giorgio, the floor is yours.
Li possiamo mettere tutti in video?
Gli abbiamo chiesto di togliere il video, che so quando ti dici di accendere la camera.
Ok. Perfect. Yep. Okay, so good afternoon to everybody. My name is Giorgio Valentinozza, and most of you will meet me on Friday. I'd like to say thanks to the Banca d'Italia, especially the branch of Trieste, with his director and vice director, and to Mr. Siracusa or Vittorio, if we can. Thanks, because your speech and your introduction was very interesting, not only for the result of the analysis that perhaps some of our students are not so well prepared to understand all the steps, and all the conclusion, but for sure the introductory part and the main ideas of investments, green bonds are very, very interesting and useful. I'd like to introduce and thanks the panelists. I start with the ladies, not only because she's a lady, but because the surname starts with B, and so it's the first in alphabetic order. Elena Belgasem. Is it right, the pronunciation?
Yes, perfect.
More or less, okay. She's senior credit analyst at Generali Investment in Paris. Is it right? You are in Paris today? Okay.
Yes.
The second in strictly alphabetical order is Ivan Faiella, Mr. Ivan Faiella, Director of the Department of Economic and Statistics, Financial Stability Service from Banca d'Italia.
Good afternoon to everybody.
Hi. The third is Mr. Michele Marinucci, Head of Insurance Relationship Management at Assicurazioni Generali.
Good afternoon.
The group. And last but not least, Mr. Luca Moroni, the Chief Financial Officer of ERA Group. That's a utility, probably one of the most, the second or the first, I don't remember, I'm sorry, Mr. Moroni. The second probably.
Depending on the days. Good afternoon to everybody.
Utility company in Italy. The first question or the first thing that I'd like to ask you or to know your opinion is something that's connected with some of the takeaway that Vittorio used or show in his slides. And especially the first question, and if you don't mind, or if you agree, I follow the alphabetical order, so we cannot confuse the order, is what do you think about the reason why to issue green bonds? Or on the other side, why is the reason to invest in green bonds? Because in our panel, we have issuer, ERA, issuer and investor, Assicurazioni Generali, with the double perspective, because from one side, Assicurazioni Generali is a company that needs resources from financial markets, so they have to issue financial instruments, but on the other side, Assicurazioni Generali has to invest the money provided by the policyholder. So it's in the double role. And the third investor, the third position is Generali Investments that operate not only for Generali Group, but for many other investors as a third-party investors. And last but not least, the regulatory perspective. So the question is why to issue, which are the benefits, generally speaking. And so I'd like to know your opinion. I will start with Elisa. If I can, you ask by name or.
Oh. Yeah, hello, and thanks for inviting me to this roundtable. So it's my pleasure to participate. And thanks also to Valentino for his very insightful and interesting presentation. So I think I will start to give the issuer perspective, although I am part of Generali Investment, so the investment unit of Generali Assicurazioni. I think from an issuer perspective, on the corporate bond market, which is my main focus, so I am a credit strategist, I see that on average, you have a greenium that is more pronounced than on the sovereign bond markets. So as an issuer, you have a minor economic benefit to issue green bonds, as you would typically pay a lower yield and have a lower coupon on your bond than on a conventional bond, on the green one. But more powerful, I think, in the marketing angle. So you clearly give a signal to both the market and the investment community that you are committed to your green strategy and to your climate strategy, and that you have enough eligible assets to have fundings to back them. So I think the marketing angle is even more powerful than the economic advantage. Now I would say more of my focus on the investment side. I think purchasing green bonds has several advantages. So it depends on which type of green bonds, because as Valentino mentioned, on the sovereign bond market, there is no clear evidence so far, but the market is fairly recent. So we might want to wait a little more to have more history. I would say on the corporate side, once you adjust for sector composition and also date of issuance, because on average, green bonds are more recent than conventional bonds. They have been issued more recently, so they are more liquid. But once you adjust for liquidity and sector composition, we have seen through COVID that they usually are slightly more resilient than conventional bonds. So that's an advantage. But the main reason for purchasing green bonds is that because we are subject to both transition and physical risks. So we are supporting the transition. We are really committed to engage in the energy transition, and we must take our part. No, I would say we are not yet at a point where the greenium are large enough to raise some pricing concerns, because also, as Valentino mentioned, there is no risk difference between a green bond and a conventional bond. So they are bearing exactly the same risk. For instance, if you take a company X, if you buy the green bond of the company X and it's defaulting, you don't have any priority in case of a liquidation. So should the price difference become too large, we would push even further towards regulator to get a preferential treatment for green assets versus conventional ones, because we want to support the transition. It is clearly our mandate. We are also incentivized to do it because we have both the risk on the insurance side and on the investment side. So we are clearly committed actors, but we live in a very, very low yield environment, and we cannot give up 10 basis points for a 5-year credit bond, for instance, without having a corresponding regulatory benefit. So I would say, as of today, we buy green bonds because we are committed to do it. We have group targets in terms of green bonds. We are happy to do it. We see the price advergence increasing. So we see the greenium overall going larger over time. We see the pressure on the investment community to go for more and more green investment. So either at the bond level or at the issue level. But we are monitoring closely the greenium evolution, because we are concerned that it would be inefficient to have a too large price difference, because, as I said, the risk is exactly the same on both green and non-green bonds. And I would say, to conclude, we are moving from we have a very, very precise green bond framework. We try to discriminate between the good and the bad green bonds. So we try to avoid greenwashing very actively. But gradually, we are more looking at what the issuer is doing at the issuer level than at the issue level. So I would say this is a trend that is very important, and that we think that we are not the only one to follow. So gradually, I would say the market is looking at what the issuer is doing more than what a special green bond would cover in terms of assets.
Thank you.
My turn?
Yeah, exactly.
By the way, thanks for the invitation. It was very nice listening to the excellent presentation from Vittorio. I would start from Elisa consideration. I mean, she's right. She's saying, well, I'm an investor, so I'm expecting a kind of an input, if you want, from you that are regulators. In our case, for example, the Bank of Italy, or the Consob, or the other entity. Well, I would say also that the regulator is expecting some clarity and some signal from governments. I mean, that's this green finance, sustainable finance stuff. I mean, it's great that we are expecting something from the financial markets. Financial markets can obviously provide resources, and there is also a role of protection, if you want. No, you want to to be sure that you are not, your assets are not exposed to the risks that Vittorio presented us. But at the same time, we have just to remember that it's not a central bank, it's not Consob that is designing the energy and climate policy of Italy, for example. So sometimes we are also struggling by the fact that there is not a clear policy signal. We can mention the taxonomy, what is the role of some of the more important energy sources to produce electricity, for example, i.e. Nuclear and gas for the taxonomy. Just to make an example. So it's kind of a game where it's not that one doesn't want to take responsibility, but it's also that one should take the responsibility that's appropriate in a sense. In that, so the first point is to have a kind of clear signal from the policymakers that the direction is that, apart from general statements that are, can be also a bit more rhetorical, but what are we talking about? Are we talking about phasing out coal tomorrow? Are we talking about having gas on board or not? That's going to make a difference, because what is classified as green or not is going to depend on this decision. So this is the first step. The second step is that we are talking about green bonds, and Giorgio asked why you should go for that. Well, if you're an issuer, I think that's a way to diversify, for example, your funding. Maybe you are we were using loans. You can use green bonds. You can use mini green bonds in the future to have a kind of diversification on your financial sources, and you can also try to exploit new markets if you want. And if you are an investor, obviously you want to you like these instruments that are pretty clear. I mean, I think that compared with other ESG-based instruments, green sustainability bonds in general are more straightforward. At the same time, what is the trick? The trick is that you don't know what's happening, if you want, behind the curtains. So you are taking this resource and then you are investing where? Vittorio showed us in transports, for climate mitigation, for climate adaptation. The point is not where you are investing, but what are the results of your investment. So if you want, what is the impact of putting the resources there? What you need is first a kind of logical framework. Now, let's imagine you want to invest in a wind farm because you are switching your for example, your power supply from coal to a wind farm. So the first logical framework here, you are decreasing the carbon intensity of the power you use. The second point, you need data. I mean, you need data to do a kind of what we call a kind of counterfactual analysis. So I mean, how many kilos of tons of CO2 I avoided because of that investment? No, that's if you want the social value of that investment. And for this data, you need also disclosure. So you need that you have a kind of picture of all the reality with and without that project that you set up with the money that you collect through the green bonds. So just to give you the flavor that I think that's just the beginning of a different way to see how you collect money and you do this kind of investment. But I think that also linked to the point of the greenwashing that was asked in the chat. That's really the point. I mean, you really need some kind of very straightforward and rigorous method to assess the effects of the investment you're making with the money you collected.
Thank you. So, Michele.
Okay. Good afternoon. Can you hear me? Yes.
Yes.
Okay. Okay. Thank you. Thank you very much. Thank you very much for the invitation, for the question. I tried just to give. Of course, for me, it's difficult to enter in the discussion because I'm the third. So several things have been already said, but I would try to synthesize like this. In order to answer the question on the rationale of having green bonds or ESG strategies in general in the portfolios, the first rationale that comes to mind to everybody of us, apart from ethical or scientific, let's say, considerations, is the economic one. So everybody, including us, including I've seen the colleagues from Banca d'Italia, wanted to check whether there is any structural yield differential between, let's say, green and non-green strategies. Okay. I read with great interest the paper from Banca d'Italia, and also I heard the discussion, and aimed at comparing the performance and the yield on the market, of course, through some interpolation between green and normal strategies. And the final conclusion that the result is mixed, actually. Of course, there are some technical difficulties in making this analysis, but we are, let's say, facilitated from the fact that, for example, some issuers like Germany adopted the so-called twin concept. So they have for every green bond, they have a conventional bond on exactly the same maturity and features in order to make easier the comparison. And also in some studies, let's say, that I read some time ago about this, basically the final greenium that is calculated is no more than 5 basis points, which means that more or less, yes, how can I say, there is a small greenium, not so high, even if statistically significant. And also from the point of view of an investor, this means that the green bonds are slightly less convenient, less attractive than conventional bonds, because the yield is slightly lower. So I make this premise to highlight a fact that is very important for me. If we think, or let's say desire, that the rationale for purchasing or holding green bonds is a particular structural economic attractiveness according to the standard measures, I think we are going in the wrong direction. Because if we continue to use the traditional models for pricing fixed income securities, we just say that the security is sensible to a wide series of factors: duration, credit spread, etc., the usual conventional ones. And in respect to these factors, the green feature is quite neutral. So also another thing that came to my mind when I was listening to the speech of the colleague of Banca d'Italia, it is quite easy, and everybody of us does this, finding ex post, let's say, a justification for a premium, positive or negative. I even myself, I gave to myself some explanation while he was speaking. So, for example, I heard the comment that the small greenium is good for issuers. Yes, but I asked to myself, but this is a comparison in a secondary market. What happens when the issuer goes into the primary market and so needs to pay a premium for issuing the security? Also, when it happens that the premium is negative, so the green bonds basically are cheaper, is this simply due to the liquidity? Or another question, is this okay, even if there is this illiquidity premium, is this illiquidity premium different or not respect to a normal illiquidity premium that could exist for a normal security? So it is something related to greenness or not? I think that these questions have no answer, because no answer as long as we use traditional models of evaluation. The only way to understand the rationale of having these securities in the portfolio is a complete change of paradigm in the mode of investments and in the asset management. So this kind of strategies make sense only if there is a strong choice made by all the stakeholders, issuers, asset managers, regulator, and the general public, when investing in these securities. And I started to hear this also in the intervention in what both Elisa and Ivan said before. So there shall be the support of government, there shall be the support of regulators. I personally took part in last year in a project whereby it was asked to GNI Group as well as other, let's say, stakeholders, to have some suggestions for the regulator in how to amend the Solvency II framework for insurance companies in order to encompass and introduce some green factors. So basically, reduce the or amend the model in order to reduce the calculated risk for ESG securities. I think this is the wrong way. So sorry, this is the correct way. So having a perceived, let's say, perceived risk and return model that incorporates this feature, that embeds this feature, and and this cannot be simply done with the standard market evaluation techniques, but shall entangle a complete revision of the risk management system.
Thank you, Michele.
So it's my turn. Good afternoon, and thank you very much for the invitation. Well, from an initial perspective, I consider the issuing of green bonds not an easy game. It is very complicated to prepare all the documentation. There are some costs, and the result in terms of convenience of pricing is not so easy to be calculated, as all the people here talk about. We've been the first company in Italy issuing a green bond in 2014. We decided to enter in the market of green bond to differentiate our sources of funding, but also we consider it a very positive way to communicate our sustainable strategy. We are a company providing public services, very linked with territories. So we are very used to do investment which have a real impact on the environment, on social life of the citizens we serve. So we consider the green bonds very coherent with our strategy, and we decided to be innovative in our way of funding our business plan, our projects. Entering into this new market at that time was very new. Governments were not in a proper way entering to that market. Only few corporates in Europe, mainly in France, and we decided to be the first in Italy to experience if there could be a real advantage. So the advantages in our experience has been to have seen a certain number of new investors attending our roadshow and decided to invest in our green bond. It was a really positive experience in that regard, but not really. I can't say in terms of pricing. So as all the people here have already said, there are not significant differences between a conventional and green bond. So I started to say it is not, and it has not been an easy game, because you have to select the projects that you consider to be eligible under the criteria for green bonds principle issued by Ecma, as we have seen, we have heard also in the presentation from the guy from Bank of Italy. And there is a process of certification that is a tough process to to have, and a system of reporting to manage the use of proceed according to what you have selected in terms of project and what you are going to spend really, and the differences to be put on other project if some fund remain available. So there is a certain work, a certain efforts for the structure, the operative people to be comply with. Well, it remains that if you believe in your sustainable strategy, in your ESG strategy, I consider green bond as a powerful instrument to communicate in a current way what you are doing. And in our case, as we are doing everyday investment project in a pragmatic way, in material way, having an impact on the lives, on the what we are discussing since here nowadays about the climate change. It is something that feel ourselves is current with our strategy and with what we are doing every day. So we are doing a project like as a plant for purification of water, just to give some example, or a plant or project to improve the waste collection separation, or a biodigester to transform urban waste into biomethane green. So it is real, something very real that we can measure, and we measure in terms of effect in our sustainable report that is very intense in terms of KPI measured on these effects.
Thank you so much. So I think that we have time for a second question to everybody, and after that I'd like to leave the floor to our participants to know if there is somebody that wants to ask something. Otherwise, I have a third question for you. The second question is, as Luca said, and Vittorio said, there are many, I cannot say a problem, but a weakness probably, speaking about not only green bonds, but all ESG investments. That's the taxonomy. So what can we define green or social or sustainable bond or instrument? And the risk of a sort of arbitrage between the rating agencies and between the place where you can obtain the certification. No? Because Vittorio showed us that there are different areas in the world with different system and different player on the market, from sustainability, that's from Morningstar to the other MSCI and so on, et cetera. So the big companies normally now, because it's a new, is a sort of something new opportunity from business perspective, they attribute the ESG points or evaluation or judgment. What do you think about the risk of the lack of regulation or the lack of definition, common definition, and on the other side, the risk of too strong definition? Because the risk could be from both sides, no? To have no definition or too large definition, or to have too strict definition. I will start always with the lady. I'm sorry for the man, but we have just one lady. So, Elisa.
No, I think it's a very important point you're raising, and I think the taxonomy slide was very interesting earlier. What I can say is that for once, Europe has a very strong competitive advantage. I think we are leading the definition of the standards, and the other economic zones are following, which is, I would say, an unusual pattern in financial markets. So I think we must leverage on this competitive advantage for once. The second is that I would say that central banks have a key role to play. We have seen last Friday the Bank of England clarifying its climate tilting of corporate purchases. So they are clearly setting a very high requirements for first being eligible for bonds to be purchased by the Bank of England. And then they are going to buy more of companies that are transitioning fast. We know the European Central Bank has announced something similar, but they haven't published the details. So during their strategy review in July this year, we had the presentation of their climate strategy. And what we know is that in 2022, they are going to ask corporates to enhance their climate disclosures. Otherwise, they won't be eligible either for repo or asset purchases. And over the second half of next year, they are also going to modify their criteria for corporate credit purchases, and they are probably going to take a similar scheme as the Bank of England and try to purchase more of corporates that are transitioning fast. And doing this, I think they are improving the disclosure standards, and they are also going to accelerate the gap between the winners of the transition and the laggards, probably. So I would say that that's a very important point. You also have the regulation side. I think on the bank regulation and insurance regulation side, you have the European Central Bank for banks and the EIOPA for insurers that are trying to incorporate some climate considerations in the regulations, and that cannot be done without a clear framework. So I think that public institutions in Europe have a key role to play to enhance the standardization and the level of reporting and disclosure corporates are going to provide to the market. And in terms of trusting the rating agencies, I think it's a point the ECB made. I think the European Central Bank said we are going to make sure we can trust the ratings of rating agencies to make sure they are incorporating enough climate considerations and climate risks over the medium and long-term horizon. And in terms of providers, of course, you see massive differences between two providers for a given issuer. And this is not going to change overnight, but I think over the medium-term horizon, we can hope for some sort of standardization, at least in Europe, of ESG approach and analytics towards the most advanced players to make sure that we have a consistent basis for analysis. And maybe one final word, there is also a pressure on our side to make sure we are looking at the right data and we are doing things well, because you might have seen the case of DWS, so the German asset manager of Deutsche Bank that is being investigated in the US for massive greenwashing. So as a large size European investors, we are really pushed to make sure we are looking at the right data and we are doing things the right way.
Thank you.
Ivan?
Well, let's say you are asking if there is possible to do a kind of arbitrage between different regulations, because you can have very strict rules in Europe, or maybe very soft rules in the US that they don't like that much to have red tapes and this kind of stuff. Well, let's start, if I may, on what is a taxonomy. Taxonomy is a classification. pretty general, no? Just say classification of what. You can classify things that are bad for the environment, and in case you're going to go for a brown taxonomy, or you can classify, that was the choice of the European Commission, what is good for the environment. It's a green taxonomy. Let's say that, you know, this choice is not neutral, because if you go for the brown, it's pretty straightforward. I mean, you know that if you're investing coal, you're not going that far away. If you're investing gas, you are definitely investing in something that is emitting CO2. Let's say that if you are investing in gas because you are changing your power plants in coal, you are reducing emission. I mean, if we tomorrow are going to change all the power station in Hungary, Czech Republic, and Poland, and we convert this power station from coal to gas, we're going to halve the emissions of this country instantly. So, I mean, just to make you an example of that, in practice, things are more difficult than in theory. And I would like really to have a brown taxonomy. Brown taxonomy is pretty straightforward. So you know that the carbon-intensive assets are going to be more exposed to the transition, are going to be more risky, and then you can attach to this taxonomy whatever you want in terms of green supporting factor or whatever regulation you want to imagine. Going for the green is more difficult because first you have to update the taxonomy, because innovation is there and these kind of things change by the clock. So you have to update always the list of technologies, and then you enter in that kind of say bottleneck, like the example of gas I made before. So the first point is that, you know, let's imagine if brown versus green. Then if you want to avoid fragmentation, you said before you have a kind of trade-off between flexibility, to be flexible, and, you know, I think that financial markets and investors like to be flexible, or to be fragmented if you want. If you are super clear in a certain part of the world, but this is not the case, other part of the world are going to have very fragmented markets. This is not good for the markets. I mean, because you want liquidity, you want to the investors to choose the best solution that they can. That's the reason why, for example, during the G20, you know, we set up this sustainable finance working group, and the idea of the group, one of the main take of the group was to try first to increase the amount of information out there, but above all to have a kind of standard principles. So the aim cannot be, because it's unrealistic to have a global taxonomy, a standardization of taxonomy, a standardization of ESG. I mean, that's clearly not possible. You have to first increase transparency. You would like that all ESG procedure, all taxonomies follow some kind of general principles. And second, for example, for taxonomy, some kind of global principles that are a kind of commonalities between different taxonomies. The example I made before is if everybody goes for a brown taxonomy, maybe what is brown in China is not what is brown in Italy. No, you would like to have a better, but you know, you need to do the transition. The transition is towards sustainability, but sustainability is also a political concept. I mean, these things must be there and stay there for decades. So, I mean, I really don't get the point of people saying, you know, for example, for gas, there's no future for the gas in the next 5 years, but that's not true. And it's clearly not the case, because you cannot change all the heating system in a year or so. No, I mean, you have to change all the structure, all the infrastructures. I mean, let's be serious about that. Then you can integrate, for example, biogas. There was an example of Luca before. Biogas can be put, it can be cleaned and be put in the same network used for the standard gas. But that's a different story. So you have to be realistic. And the idea of having a discussion going on for trying to connect these different taxonomies, I think it's a very promising and good idea. Again, let me be blatant on this. I think sustainability is an important concept. Vittorio told us, you know, sustainability is not just environment, it's environment, social, and government. Environment is not just climate, no, is biodiversity, protecting ecosystems, and so forth. But let's start with climate. Let's focus on climate, reach some results on that. First, because climate is connected to many other environmental issues. So, I mean, when you fix climate, you fix a lot of other stuff, water use, ecosystem, healthy ecosystem, and so on and so forth. And second, because
please keep the focus on one thing. We have a lot of work to do. When we are fixed that, then we can go to the next level and widening the scope, including also other point of environment, widening to the social issues. For example, social issues are key, are important, but you understand how difficult it is to find indicators, KPI for social issues. Why it's super easy for climate? I mean, emissions up, no, not good. Emissions down is good. Too much water, not good. No, you're saving water is good. That's a completely different story. Inequality versus poverty, jobless households. I mean, it's really tricky. So let's stay focused, learn as much as possible within this process. It's going to, I mean, it's changing. It's a kind of a revolution for the financial system, and then go to the next level.
Thank you so much. Michele?
Okay. Yes, I think that I would see this your question and in general this discussion under the eye of the very common, let's say, discussion at the moment related to this called greenwashing. Okay, so of course, as you it was already slightly mentioned, the green investments.
Sorry if I interrupt you. Yeah, I don't think only to greenwashing, but if you are an investor and you have a different definition of what is ESG under the ESG definition, you can decide to invest in a product or in a company in US or in China that is ESG compliant from a certain perspective, but for example, is not for European. It's not really greenwashing because
no, it's not.
No, it's
yes,
my idea is more complex or more.
Absolutely. Maybe let me just a bit elaborate on that. So for sure, the topic of green investment and the attention to ESG was built up on from scratch, let's say, with a very bottom-up perspective. Okay, so at some moment, some issuers started to issue green securities. There started to be an interest, and this is great because this is very interesting because it testifies a spontaneous, let's say, interest from the market. It is not something that has been imposed top down, but corresponds, let's say, to a real need that emerged from the world of investors, issuers, etc. It is something allow me to say a bit far from our from the mentality of those countries that are more bound to the civil law, like Italy, for example, because we are starting to do the opposite as a mental process. Normally, we start from the law, we start from something analytical, and then we see the consequences. This is something, allow me this comparison between with the regulation, something like more similar to a common law, so something that comes from scratch. And of course, the first question, and that was the connection with the greenwashing I wanted to do, is that this generates the suspicion that if there is no standard rule, if there is no concrete, very stable framework, there could be some cheating around that, because of course some investors could declare that something is green, some issuers something is green while not being so. What can we say? Is this in bad faith or in good faith? Probably okay, episode is in bad faith needs to be persecuted, but of course, if there is no rule at all, as Giorgio correctly mentioned, even in good faith, there is the possibility of misunderstanding among stakeholders. Okay, and so the lack of standardized criteria to distinguish what is green from what is not, and also to consider, allow me to say, the different shades of green, so the different degrees whereby an investment is consistent with some ESG thematics, could be an issue. I think that a great effort has been done in the latest years on the topic of taxonomy. And also, I'm personally more concerned from the world of asset management, where the SFDR directive is now giving more objective criteria also to classify investment products into some predefined and well-described categories. Also for us in Generali Group and at the Generali Investments level, there has been a strong activity aimed at, let's say, getting familiar with this approach and to classify all our funds, all our investment products according to this criteria. This goes into the right direction, but the great challenge, in my perspective, is double. The first one is to keep an equilibrium, so avoiding to go into the excess from the other side. So if we want to classify everything, as Ivan correctly said before, it's not so easy, especially in the other fields of ESG other than climate. And if then we just so reducing this complex matter into a series of KPIs could be dangerous, because could be sometimes misleading. Also, the other great challenge is to think global. If rules and constraints are designed only for some areas of the world, like although they could be, I don't know, big like Europe or US, they will only create, let's say, imbalance and undue competitive advantages from some other areas of the world. So this is a great challenge ahead of us. We have seen also in the recent news. In these days there is the COP26 in the UK, and the great challenge is having all the stakeholders around the same tables, also from a geographical perspective. And I think that from this point of view, we are a bit far from having a common approach, let's say.
Thank you, Michele. Luca?
I consider taxonomy as a first step in a continuous scenario in evolution pattern. Why I said that? Because taxonomy is for sure set the classification, but also set some targets and limit above which you can go in terms of emission, for example, and that could have an impact on certain project that maybe before taxonomy has been considered sustainable or green, and after taxonomy they are not anymore. The example of gas is the more real one, and is under discussion even at the European Commission level. And you know that within the end of this year, maybe another document should be issued to clarify how to treat gas, because what said Mr. Faiella before is absolutely correct. It depends if consider gas in compare of what? Coal or renewable energies. We are discussing inside our company about hydrogen. Hydrogen is a new way producing green energy, apart that we need to be on the same picture to say it is fully green, because you have also brown hydrogen, blue hydrogen, and green hydrogen. It depends on the technology you produce hydrogen. But this is a technology that we will see in place in 10 years. Nowadays, all our cities are equipped with the pipeline of gas. The gas distribution is everywhere. If you try to put hydrogen into the gas pipeline, if you don't respect a certain percentage in blending, you destroy the pipeline. It is corrosive, hydrogen, so aggressive. So it is not just a matter to produce it and to put it in a way in the same pipeline in which the gas is distributed to the houses. So it is very complicated. It is important to have set a classification, but this is only the first step. And to be tougher and tougher in set parameters that are not realistic could be not in line to make to go through to go towards an incentivation of exploiting new technologies and new projects in order to have more renewable energies, more renewable projects, more and helping to achieve target in terms of net zero emissions. So it is a difficult topic to manage in a proper way, in really proper way. Again, if you see what it is eligible or what it was eligible in terms of green project to be financed throughout green bonds before taxonomy, you have a choice bigger than the one you have after the taxonomy. The biodigester producing green gas I mentioned nowadays are not anymore eligible. So companies decided to differentiate again and to move to sustainable linked bond. That is an answer in a way, if you want, to that approach that it could be perceived as tough in terms of setting certain principle, very hard to be achieved.
Thank you. There is a question from the online participant, from an online participant. Question for Ivan. How do you see the transistor risk you speak in the light of recent agreements signed by Italian government on the sidelines of COP26?
Well, COP26 is going to finish this week, so I don't think there was nothing signed up to now. There were many initiatives, not in particular from the Italian government. The Italian government participation is important because we not only had the G20 presidency this year, but we are co-hosting the COP26. I think that there are some many positive messages coming from COP26 and from G20 as well, if I may. The first one, I know that Italian press was pretty negative, for example, when Rajendra Mori declared the intention of India to go to net zero by 2070, because everybody said, you know, it's not 2050. The G20 say it's around the middle of the century. Well, I mean, we have to remember that we are talking about a country that has a kind, I mean, it's 30% of the people there, they don't have access to modern energy sources. Their GDP per capita is something around 1/7 of the GDP per capita of an average European, and their per capita emission are rather low because the energy use is pretty low. So having that kind of commitment is an incredible achievement, a success. Why? Because India is going to catch up to be the bigger countries in a few years from now. So it's going to overtake China in 2030, being the most populous country. So it's going probably to become the most important emitter. Never we had a moment during this climate negotiations since they started after the Rio conference where there are so many countries pledging that kind of emission. So the first point is that
that's linked, if you want, in what I stated before. This transition is going to take time, as always. We transition from wood to coal, then to coal to oil, then to oil to gas. These things didn't take a few months or a few years. It took decades. The same is going to happen for also this time. So that's great. I also think there are many other optimistic view. For example, there was a revision from the global carbon budget of the actual emissions of CO2, and they showed that actual emissions of CO2 in the last years were downward revised, so they are flat actually, because they revised the way we are estimating the intake of carbon emissions from the natural sinks. So that's again another good good information, I think. Then it's a day-by-day challenge, I think, that is going to affect the way we are consuming energy. There is not an easy way out. I really hope that Italian government, as the European Commission suggested, for example, is going to change the taxation system, also to take into consideration emissions. So to introduce a carbon tax, I think would be a great idea, even at a small, small level, than to increase that according to our targets. But I'm rather optimistic.
Thank you. Vittorio, do you want to add something? Yes, please. Okay.
Thank you. Just since we have a few minutes before concluding, it is a question for Michele, in the sense that he was saying something about different models to evaluate assets, especially to see if there is a greening or not. We understood this challenge, which is, of course, a great challenge to be tackled by the asset manager perspective. What can you tell us from the insurer perspective when dealing with these risks? How can we turn these risks into potential models to be analyzed in order to understand where the difference stands in market pricing among these instruments? Thank you very much.
Okay, thank you. Thank you for the question. I will try to reply in a very synthetic way. ESG topic at the end of the day is a different, more refined, more complex, let's say, but way to perform some risk management analysis of the portfolio. And so, as every risk management framework, it has its rules. The risk is not something objective. Sorry for that. It's something that is calculated according to some rules. So from an insurance perspective, of course, we have an insurance portfolio is measured on some parameters of income and on some parameters of risk, but the risk is the risk calculated according to the model that is applicable to insurance companies, which is Solvency II at the moment for the European insurers. And that's why I came back to the point I made before, and there has been some suggestions, some public consultation to have, and the GI group also participated to that, to have some proposals, let's say, for some KPIs in order to incorporate some ESG topics in the evaluation of risk. Let me make a parallel with some other kind of investments. As you know, in the Solvency II framework, as you may know, in the Solvency II framework, the risk associated to government bonds is 0, because they are simply associated to a concept of risk-free rate. Is this true or not? In some historical periods, probably not. And okay, and also for some countries, okay, it's a bit more complex than this, but I just try to simplify. So But as long as there is somebody that tells you that the government bond of your own country has a risk factor 0, of course, this is an incentive to see the things under this perspective. If we can mutualize this kind of approach for ESG topics, I think this can give an impulse to the introduction. Because if we stay just with traditional evaluation methods, as you showed in a very complete way, let's say in your analysis, we will reach no result in assessing whether the ESG or whether the green bonds pay or not a premium, are convenient or not for an investor or an issuer. I don't know if I replied to your questions. To your question.
Yeah, Vittorio shake the head.
Because in a virtual meeting is not so easy.
Yeah, exactly. There is another question from an online participant, but I'd like to know if there is somebody here in the room that want to ask something. No, they want to go home. Okay. Okay, so I read the question for Elisa and or Michele. But we will give the floor to Elisa because we are very polite. We are gentlemen. What role do the data providers play in the ESG investment decision making? What kind of data do you use for the evaluation models? Elisa?
Okay, thanks for the question. So I'm not sure which provider we use is public information, so I will not comment on this. But what can I say is that, yes, we collaborate with external data provider on ESG. Which type of data? I think there are a great range of data, but just to give you an example, for instance, carbon emissions, so scope 1, 2, and possibly 3 as well. And what role does it play in the investment decision making? I think this is clearly what we are in the middle of doing. So it's the ESG integration process. So you have various stages of it. On one side, it is used by credit research analysts. And for them, the question is how much ESG profile of company is going to affect the financial metrics of a given company. It is also used on the investment stewardship team level to define and deal with the exclusion list. So for instance, there are some sectors, some companies we cannot invest in based on ESG criteria. And it is also used on the, or it will gradually be implemented also on the portfolio management side. And there, I think it is more, well, they are clearly relying on both the investment stewardship and research analysis, but they add another layer is on valuation and how much ESG criteria are applying to and are impacting valuations. And for this, I think it is a dynamic approach, and we are, as we mentioned, the Greenium is a relatively small fund now, but still more significant on the corporate side than on the sovereign side. But there's more to it. I think we see some sectors, for instance, being already affecting in credit markets with regard to their ESG profile. It is the case of the oil and gas sector, for instance. It's been performing relatively well on the back of the re-rating of the commodity sector, but not as much as in the past. So the correlation has been weakened by its weak ESG profile and very strong carbon issuing profile. And it could be also the case, for instance, for the tobacco sectors. As you see more and more asset managers announcing their interrupting their investments in this sector. So you have an investor-based question, and that is more and more affecting valuations. So I hope this answers your question.
Thank you. Michele, do you want to add something?
Maybe okay. I would just add the fact that we need, let's say, okay, yes, for sure, we use a lot of sources of data, but the important thing is also to develop, because something is still underway, to develop the capacity to be selective in terms of data and to adapt the KPIs to the single reality, the specific reality of the business. If you look at the www General Investments website, probably you will be surprised of the fact that it is clearly stated that even each of the asset management companies that make up the, let's say, the multi-boutique approach of the GNI group, so the different asset managers of the group, adapts the ESG parameters to its single reality. This is a great effort. It seems counterintuitive because one could think that there are some standard criteria that should be valid for everybody, but you may imagine that being green in the sector of real estate is not like being green in the sector of I don't know, traditional securities or investments. Also, we need to consider that we always speak about green, climate, but of course there are a lot of dimension of ESG, as I think it has been mentioned by I remember possibly even before. Okay, so in this case, yes, the data are important, but it is also important to be selective and to study appropriate KPIs. Otherwise, we fall in the trap that to having too many data, too many perspectives, but not having a great clear framework in order to analyze them, let's say.
Thank you, Michael. Other question? No. So before giving the floor to Professor Tracogna for a final greetings, I'd like just to summarize or to provocate all the participants. So from one side, for sure, everybody knows that it's necessary to do something, especially for climate change, but it's not, climate is, as Ivan said, the most miserable and directly measurable variable that we have in the ESG. Is not the only one, but it probably is the most important and measurable. On the other side, if I look to the same problem as an investor, I don't like a zero return because the bondholder or the issuer is a very good citizen, no? To use this euphemism. So perhaps, but it's a provocatory statement. Why we cannot connect the bond or reward not with the quality of the investment, the specific investment, but to the capacity of the company to reduce or to improve pollution, water waste, etc., at a general level, measured by an independent authority or third party, and because we want to improve our world and our environment, etc. But at the same time, we don't want to reduce the return to zero, not only because otherwise Generali cannot pay the the participation of our students at the master program, but for many reasons that we know perfectly. Why we cannot reduce taxation for companies that are able to produce tangible results? Because at the end, if a company reduces pollution and reduce damages to environment, is a benefit for everybody. So in my opinion, it could be, of course, it's a provocative statement, a sort of win-win thing, because the investor can receive a certain rate of return. The company are incentivized to reduce pollutions, to go in the right direction, and the state can use the private resources to obtain a public result. This is just a provocatory statement. Okay, I don't ask to our panelists to comment because it's already 20 minutes to 6, but if you want to share your opinion on my email, I really appreciate. And I give the floor to Professor Tracogna for a final greeting. Thank you so much.
Thank you so much, Giorgio. Thank you so much, Vittorio, and to all the speakers for having contributed so much, and also to the audience, both from remote and from the whole, for having contributed to this very interesting meeting where we have raised several questions and tried to answer some of them. But of course, you understand easily that the topic is very hot and it's still to be fixed somehow, both by the regulators, by institutions, companies, and the public opinion too, because of course, everything is somehow directed by, you know, the expectations of us as citizens. So let's see what's going on, you know, in the coming months. And but again, the topic is at the top of our agenda, both for, you know, for corporations, institutions, and business schools as ours. So thanks again for everybody, and we are looking forward to the next steps, the next meetings. And thanks again for Banca d'Italia for having proposed this very interesting meeting and presentation. And again, thank you very much and have a good evening.
Thanks a lot for the invitation.
Thank you. Thanks a lot.
Thank you very much. Have a good evening.
Have a nice evening.
Bye-bye.
Bye-bye.